Assalamu Alaikum everyone, welcome back to the channel. In today's video we will be looking at two things. First thing we're going to look at is the stock watch list that I've created myself. Some of you asked me if I can share this with you, so I'm going to show you how it works and I'm going to share it with you, show you the formulas, how it works and why this is really important. But before we do this, we're going to look at something called value investing, and I think this is really important for investors, whether you are new, old, whatever you are. This is really important that we understand the concept of value investing. Right now there's a lot of people out there that are just talking about stocks but have no idea how to value companies and how to find companies that are basically under their, companies that are under their value, basically under their intrinsic values, if you like, or the book value, whatever you want to call them. Okay, so that's the second thing, first thing we're going to look at, and the second thing will be just going over this and how the two are linked. Okay, and I'll show you some of the formulas and how it all comes together. If you are new here, please subscribe, like, and let me know if you have any questions. Thank you. Let's get started. Right, so the first thing we're going to look at is what value investing is. Okay, and if we scroll down, what you will see is, this is the Investopedia website. Value investing is an investment strategy that involves picking stocks, okay, that appear to be trading for less than their intrinsic or book value. What that means is basically they believe, so these investors that call themselves value investors believe the market, okay, overreacts to good and bad news, resulting in stock price movement. So what happens is, because there's a little bit of bad news or a bit of a good news or something, a company has missed some of the estimates or whatever, what happens is all of a sudden the stock price goes down, or it goes up because it's actually done a good job, whatever. Now if it goes down, obviously that's when you look at the company and just look at their intrinsic value or the book value and see what the company is worth. If the company is basically worth more than what's currently trading, then that is a discounted price or on sale, and that's when we buy. So when you go to buy new trainers, whatever, and you see a trainers that are discounted, obviously if they were £200 and now they're all of a sudden £50, you're not going to walk past them. You'll probably buy them because you know the quality of those trainers. Now probably that's a bad example, but it's similar to that, because the stock price is trading lower than what the company is worth. Obviously then it's a good time. It's a time for us to buy. So value investing is something that I've learned while I was reading the book called the Intelligent Investor. Okay, Benjamin Graham, which is basically the lecturer, if you like, or the professor of Warren Buffett. So he's actually massive advocate of value investing, and all we're doing here is just buying companies under their book value, so how much the companies are worth. Now there are a few ways to find out what basically how to calculate the intrinsic value or book value, but I'm just going to show you one of the formulas they use. Okay, and that's called the discounted cash flow. Now this is very complicated, and I'm not gonna get into this at the moment. Maybe I'll do a video in the long run. I'm not doing this either at the moment. I'll show you what I'm doing, but there's a formula behind it, and it's basically step by step explained how it works and so on. So if you're interested, go to Investopedia website and type discounted cash flow. Now what this allows them to do is to find basically each stock they have. So I'm using right now Morningstar. Morningstar uses this formula to find out whether companies are overvalued, undervalued. Obviously they use other formulas as well. There are a couple of other formulas out there, but that's one of them. So the discounted cash flow is one of the formulas they use to find out whether companies are over or undervalued. Now if you look at Merck, for example, okay, Merck is basically a pharmaceutical company. I own, I think, 25 shares or whatever they are, and currently traded under their intrinsic value. So the fair value for this company should be $94, but $94, but at the moment it is $78 per share. So there's a bit of an upside there, and there's one way to find it. If you can find those companies like this, but obviously the balance sheet has to support this as well. They have a great balance sheet. Then you are sitting on gold. Then that's when you start making money, because they are undervalued. They will go up soon. They'll probably pay you dividend. You reinvest all of that. Obviously the price appreciation as well as the dividend reinvested, you are definitely going to make money. And that is the whole point of value investing. If you're interested, read about it, but get that book. Honestly, if you don't have it, I'll put the link down there. It's a great book. Honestly, it's huge. It took me a long time to read. I've highlighted mine. I've just, some of the information in there is slightly older, like because this book was released a long time ago, but it's actually updated recently. And if you go on, like, there's sections where they talk about bond markets and all that stuff. I skipped those because I'm not actually buying any bonds or anything like that. So it's really good book if you're interested. So value investing is just buying companies under their intrinsic value, under their book value, and holding on to them until they go up. And if you want to sell them, then you can sell. Basically, you're buying low and selling high if that's what you want to do. But if you are long-term investor and you're thinking about 10 years, whatever, it's really good thing to do to actually buy companies that are under their fair value. Now, I use two websites. I use Morningstar and I use obviously Simply Wall Street. Now, Simply Wall Street is they're a bit generous, I think, because they think the fair value for Merck, for example, should be $210 per share, whereas currently trading $78. So that's a massive upside. That's 62%, almost 63% up from where it is currently, whereas this is a bit more realistic. So I normally go with this, or sometimes I will take this and I will take this and I'll just see the difference, and I'll go like kind of middle-ish if you like. So let me show you now how this is linked to what we're talking about here as a value investors. So I've created this so that all these companies that I have in here are the ones that I'm interested in buying or adding to in the next couple of months. And then if I put this information here, and then I will put the same information on my trading 212 account, I will just put the ticker and I'll put the price I'm willing to pay, so my ideal entry point. And then every time it basically hits, for example, Salesforce, every time it hits $529 per share, okay, I will get an alert that says this price has basically been met. So if I have the money, I'll buy more. If not, I'll just wait maybe a couple of more days and buy them later on. Okay, so that's the whole point of this watch list. It's really good way to stay disciplined, and that's what we need as investors. So what we have in here, let me show you how this works. So we've got, let me use Merck as an example. Okay, so we've got the ticker there. Automatically you will get the name of the company, then you just need to put the sector or the industry. Then the PE is normally current PE, so it's not forward PE, so you might see a difference. So if you go to Merck, for example, here, it will say 12 because this is forward PE, whereas this one is a trading basically 12 months. Okay, so it's basically current PE if you like. Then you've got the current price for that company. Then you've got the fair value, which I've got it from Morningstar. Then this is the most important part. So the margin of safety is something the intelligent investor talks about a lot, and this is really important because remember, if we go back here, this is just estimate. So this basically whole formula, what they're doing, they're estimating what something should be, so the price of the company. So they estimate the value of an investment based on its expected future cash flow. So that's what they're doing. So when we go back here, anything can happen. They can overestimate, underestimate, something can go wrong. So I don't want to holding back. I want to be able to make money. So therefore, I have a margin of safety. So some companies I'll put 5%. Some companies I'll put a little bit more because I'm not too happy about the company, or I might think it's they overvalued at the moment, or something is going to happen later on, or the business model might change, or there's a bit of risk involved, or they're very hyped up company like Nvidia in here, for example. Okay, in Nvidia I put 15% because I want to make sure that I don't lose any money if something happens to this company. Okay, so at the moment they're going through a phase where they're doing split, they're buying a new company from the UK and all that stuff. If I had this company in my portfolio and all of that is happening, and I put the margin of safety of 15%, I'm only paying for $438 per share, whereas currently trading 800. Okay, and it drops almost 50% or whatever it is, then I'm happy with that. But if I buy it at 800 and the fair value is only 500, then you're definitely going to lose money when people realize this company is not worth what is trading at the moment. And this is one thing that we really need to understand. If Nvidia goes down tonight, okay, and goes back to the intrinsic value, okay, like where it's supposed to be, then you are going to, if you bought it for 800, you're going to lose at least the $300 per share. And that's a lot of money. Okay, the money that you could have invested in another company or do something else with. So this is the whole point of this margin of safety. Then we have the ideal entry point, which is basically subtracting these two from here. Okay, then so once the company hits this, okay, once it hits my ideal entry point, this will tell me whether how much off I am. Basically, if it's green, then that means I should be buying these companies. So like companies like right now, Merck, for example, or Polaris or whatever, should be a buy right now. So I might just decide, okay, 11%, okay, I can wait. So I might actually decide to add a couple of more shares of these companies that are in the green if I have the money. Then you got the 52-week low, and then you've got the 52-week high. As well as that, you've got the percentage of the 52-week low and of 52-week high, which is good. Again, to basically kind of gives you an indication where the price was, where it is right now. So how much went down, how much it went up, the difference, okay, between the two as well in percentages as well. So it gives you quite a bit of information, but the most important bit for you, for me, for everyone is the current price, the fair value, the margin of safety, and then your ideal entry point. Once you know you've actually is in the green and you're ready, you've got the money, then you can start buying. So Salesforce, for example, is about 4%, whereas TSM is basically 0.6. So I might just say I'm not going to add to that company for now. I'm going to wait it till it drops another 2%, 3%. Okay, just to give myself basically a little bit more margin. So again, that's all I wanted to share with you today. The final thing actually I'm really excited to show you today is this. Right, so let me show you how much I've been paid just yesterday in dividends. Look, Kimberly-Clark, £10.50. I've been paid £3, over £3, over £8, over £11. I think that was about 30 something pounds I've just been paid yesterday in dividends. That's amazing. That's probably more than, let me just quickly have a look actually. So this time last year I was paid 15. The whole month I was paid £15, about £16 for the whole month. And already, well, 6 days in, okay, today is the 6th. So 6 days in, I've already been paid £33.16, which is really good. So again, by buying this sort of a companies, holding on to them for a long time, they'll pay you a dividend and then just reinvest. So right now, if you look at my account, you can see I've actually got £33 to invest today in the stock market. So I'll take that money and I'll split it into different stocks, or I might just put it into one. Whatever happens, it will be reinvested straight in back into the stock market. Right, so that's all I wanted to share with you guys. All you need to do once you get this, I'll put the link in the description. All you need to do is click file, make a copy, and then it's yours. You can do whatever you want to do. The reason I put this together is to help me basically make sure I'm not buying companies randomly. Okay, so randomly you see a company like Nvidia, they're not on your list, and you see them going up, everyone's talking about it, you buy it. No, don't do that. Don't do that to yourself. Have your list, be disciplined, stick with what you need and what you know already. Make sure you do your research, make sure you know everything about that company before you put a penny in. Every single company right now in here, I know exactly what they do, where their money comes from, and so and so. And it took me a very long time, trust me. Okay, and if you are new to stock market and you basically start to invest in, then just buy a couple of shares from the companies that you already know, okay, and stick with those for now until you learn more about. So if you've got Apple phone, then you know your Apple is one of those companies. If you own a computer that runs on a Microsoft product, then you know Microsoft and buy some of their product. If you own some sort of the tissue from this company, do the same thing. If you have a child and you're buying baby products for Johnson & Johnson, maybe it's a good time to actually invest in that. Okay, and I'm actually doing a video, I think this next week, just on basically how to start investing in first time. So I've realized there's a lot of new brothers and sisters in the group, so hopefully I will do it like a kind of quick overview of where to start, what to do. So I'll let you know when that happens. Anyway, thank you very much for watching. If you're basically still here, please like, subscribe, let me know if you have any questions. Assalamu Alaikum, take care.